I think there's a lot of folks who've been beat up and beat up pretty bad. And there's, do you go back in the water now, or do you think that the water is going to actually get colder in May?
It's just been a really, like, as you just were saying in the intro with these weak performances in April, what made matters even worse in April was the fact that there was no cushion from bonds. The 60-40 portfolio had one of its worst months ever in April, and it's one of its worst 4-month stretches on record. So this kind of nowhere to hide environment for investors makes things really difficult. But we're looking at this weekend. The short term. We hear all the short term. What's going to happen? Who knows? The futures could be up or down sharply from now, an hour from now. So I think, though, what you look at this weekend is you saw during the weakest part of Q1, that's when Berkshire was buying 80% of its Q1 equity purchases were in that weakest, like, 2-week period stretch. So for a long-term investor, you want to look for companies that have solid earnings, and have solid prospects. I think you want to focus more on the value side of things here, and companies with attractive valuations, because as long as the Fed is here continuing to loom over the market, it's going to be hard for some of these higher valuation stocks to do well.
Neil, what do you think?
Yeah, it's definitely been a brutal couple of months for the equity markets and the bond markets. There's been a confluence of risks that's come together that's heightened the uncertainty level to a level which we haven't seen in a while.
So what do you do about it?
Yeah, we are advising our clients to stay invested in the markets. It's very hard to time these kind of gyrations. Our research shows that the longer you stay in the markets, the lower the probability of losing money. 10 years you stay in the market, the probability of losing money is about 6%, versus if you're only in the markets for 1 year, it's about 26%. So stay diversified, stay invested. We think you should look under the hood of the indexes, look at factors like high quality, solid balance sheets, dividend yields, operating leverage, pricing power, etc. We're also advising our clients to bring alternative investments into the fold as well as real assets, because you can get some of that diversification benefit, and you can also get some inflation hedging and some enhanced performance there. And finally, I agree that looking at the commodity side of the equation in the equity markets makes a lot of sense. Energy is one of our favorite sectors. It has been for over a year now. Earnings revisions are still very strong there. Our house view is that Brent crude can go to $120 a barrel this year. There's a natural inflation hedge in the energy sector, and I think investors are still underweight there. So value, commodities, real assets, and full diversification.
Paul, is there a moment where people are going to say that tech is actually a value, given how much we've seen stuff sell off? I mean, there is a question as to whether what was happening during the pandemic was this sort of one-off, idiosyncratic Alice in Wonderland moment, or whether, there was actually true value within that, and sure, pull forward, but maybe when you look at where the prices are now, there is value, or you think you can't even look at what those prices used to be and say, okay, it's down off of that?
Well, no, I mean, I think you can look at, you can make comparisons to pre-COVID levels. A lot of these stocks have come in, but what the key is you don't necessarily have to say we have to get back to pre-COVID levels for all these stocks, because the earnings have grown. We've seen strong earnings growth in the higher quality tech companies, but still, at this point, you have the Fed being very tight over the market here. And you have value trading cheaper than growth. Growth trades at about 24 times earnings. Value trades at about 17, 18 times earnings. So in that environment, you want to focus the companies that have the present earnings and the present cash flows, rather than the companies with the future prospects. You want to focus on the present rather than the future. Right. And so I think in that respect, until the Fed starts to show signs that maybe they're getting ahead of the situation, which we're nowhere near. We've only hiked 25 basis points at this, coming into now. I think you're going to see the value trade continue to do better here. If you look over the last 6 months, value has done really well relative to growth. Energy has done really well relative to technology. But if you zoom out to, say, a 20-year chart, you can barely even see the recent outperformance on the chart. So right now they're making up for years of underperformance. So there's plenty of room for more growth in the value trade, so to speak.